All right, let's kick off this segment from the global oil market as prices extended declines in early trade today, pushing U.S. futures below $80 a barrel after Iran and world powers agreed to resume nuclear talks this month that could lead to the removal of U.S. sanctions on Iranian oil, increasing global supplies. U.S. West Texas Intermediate crude slid for a third day to $79.94 a barrel, down 92 cents. Brent crude futures for January fell for a second session to $81.19 a barrel, down 80 cents. Both benchmarks on Wednesday posted their biggest daily percentage declines since early August, with Brent closing at its lowest since October 7 and WTI since October 13, after weekly inventory data from the U.S. Energy Information Administration showed a larger than expected rise in crude stocks last week. Later today, the Organization of the Petroleum Exporting Countries and its allies, a group known as OPEC+, will meet. The group is expected to reconfirm plans to keep monthly supply increases steady despite calls for an acceleration. And for more on commodities market space, we have Belumi Olanubi here with us. Hi, Belumi. Good to see you again. Good morning.
Good morning. Thanks for having me.
All right. I think it's a good place to start with the Fed's decision. Yesterday, they are beginning to reduce their asset purchasing program. Yeah. That is supposed. They also signaled that they are not going to increase rate hike. They're not going to hike the interest rate. So what would this decision mean for the global economy and, of course, for Nigeria?
Putting this in context, we know that the United States is actually the largest economy in the world, followed by China. And about 69% of global foreign reserves is actually denominated in dollars. And also most of the trade, like 88% of global trade, is actually carried out in dollars. It means that the U.S. economy and policies, both fiscal and monetary policy, is actually very important to the global economy. Now, let's take a look at what is going on in the United States and directly what we can take home and how it will directly impact Sub-Saharan Africa in general. Before pandemic, the United States had a stable economy in the sense that unemployment rate was at what we call the natural rate of unemployment, which is about 2%. That's what we call full employment. So also interest rate was well anchored and it was below the benchmark of 2%. It was around 1.6%. And the interest rate was 2.1% there, but that was pre-pandemic in 2019. Now, after the pandemic, the impact, the lockdown and all that, we saw contraction in the economy that led to unemployment levels recording as high as 8%. And also we saw that at that period there was squeezed liquidity, so the Fed began to purchase assets just to push in more liquidity into the system. At that period also we saw that they left interest rate artificially low, and this is actually very significant to commodities prices that was all-time low last year. So as we come out of recession, as the rate of vaccination improves, as we see more economies open up, more sectors open up, we see that inflation rates rather, began to increase, and it is followed by so many factors, one of which is the energy price that we see, price crunch, supply disruption, and what have you. So at this point now, the pressure, actually pressure for the central bank to raise interest rates, but their own perception is that it is actually transitory. That it's just some factors that are proving not structural in nature, and it will fizzle out.
But a lot of economic analysts insist that this has become persistent.
It isn't persistent looking at it, because if you look at the drivers, they are actually energy prices. We've seen supply chain disruption and all. If by the time more economic activities economic activity increases, and we see this disruption, this supply chain disruption being addressed, we see increase in commodity price, we see more surplus supply rather of commodities, and we see more activities generally. We'll see that it will actually taper down, and they are actually forecasting that by mid 2022, we will see that. In fact, in the words of the Secretary General, she said that inflation expectation, which is actually the language now, is actually well anchored. So for us in Nigeria, and the impact on global economy means that the dollar will be relatively stable for now, and we don't expect commodity prices to increase based on the increase in the value of dollar, but we just expect that the fundamentals, which is the structural issue that we are seeing, the supply bottlenecks that we are seeing will be the major factor pushing commodity prices. And that implies that, but however, rates hike is inevitable coming 2022. And that would mean higher debt burden for SSA countries and even global economic at large.
Now, the Fed decision to taper its bond purchases, of course, is expected to, help rein in its inflation. But you talked about the rising energy prices, which, of course, is also contributing to the inflation that we are talking about. Now, this tapering now, is it enough to actually rein in this inflation?
If we look at the balance sheet of the Fed right now, it's actually as high as we have $8.56 trillion, and this is higher than what we even saw during the financial crisis in 2008, 2009. And we've seen that the Fed have decided to taper down in the quantitative easing, even asset purchase and all, just to reduce liquidity. This will have a minimal impact because if they increase interest rate at this point, it's going to cause more destruction as it were, but it will have a minimum impact that can be managed to see what is going on. And if inflation expectation is well anchored, we would see that as projected, as expected, by the mid-year 2022, we should see global inflation taper down.
Right. Now, OPEC, of course, is meeting today, and the U.S. is currently still pressuring the group to actually raise supply to help it, keep a lid on inflation. Now, do you think the group will actually succumb to this pressure?
Like we discussed on Tuesday, I still stand on my own opinion that the likelihood that OPEC will heed pressures from US is actually very slim, and because it's not just about reduce. Of course, for the US, the factors driving this are actually is politically inclined. We know that mid-year election is coming up November 2022, and one of the factors that we'll be looking into is how much or how well this administration has actually dealt with inflation or at least reduce inflation to the target rate. So these are the considerations. So OPEC would most likely stay on their own what they've agreed on, which is to increase supply by 400,000 barrels every month, just to see, that's a more conservative way of approaching it. If not, we'll see oil price decrease further than we have seen, because we've seen this decrease is actually as a result of the pressure mounting up from the United States and all, and even the conversations going on COP26 and all that. So those are the sentiments driving this price right now. But if they eventually decide to increase, take it to the pressure, we will see our price decline as far as probably
some analysts are of the view that they don't see OPEC actually succumbing to this pressure because the COVID-19 is still there.
It's still there.
So there is still this fear that, demand will also still be, affected. So perhaps this is not the right time to
The recovery is actually progressive. As we are saying, the rate of vaccination, like we all know, globally now, the rate of vaccination is actually skewed more to the developed countries. They've vaccinated to as high as 70% of the population, while in developing countries like we have even in Africa is as low as 6%. So it shows that the rate of vaccination and the threat of COVID-19 is still very potent. And these are the considerations that we put together before any major decision is taken.
Now, of course, it's obvious that the concern of the U.S. has to do with inflation. And at the just concluded annual meeting of the IMF and World Bank, it was also one of the concerns that delegates there raised the rising, global inflation, and talking about how countries or monetary policy authorities can actually try to draw a fine line between supporting recovery and, targeting inflation. Now, a lot of people, investors, I'm sure, will be cracking their head now. Okay, what do we use as a hedge against this inflation? Some people would say gold, or should we go to crypto?
Oh, in my own opinion, it depends on your own investment. I'll use the word your appetite, your risk appetite. So to some people that want to go all out, they can go as far as probably investing a huge part of their investment stock in crypto, whilst the conservative one will still stay around. Some yield bonds, assets that are still yielding fair rates. But it depends on your appetite, actually, for this kind of investment to hedge against. But in commodity space, some actually engage in this forward contract to see how they can still hedge against, at least minimally, to hedge against rising prices.
All right, let's look at the ongoing COP26 summit. Of course, Nigeria committed to meeting targets by 2060. What does that tell us?
a lot is
10
actually
years
going
after, the UN's targets.
A lot is actually going on there, even globally and even for us in Nigeria. Now, Nigeria actually signed this Paris Club in 2017. It shows that we are actually committed, and the way our president actually represents and all he mentioned, it shows that we actually in this conversation. And he also raised that in the bit of transitioning, we don't cause energy crisis, even in Africa. But, I mean, looking at what is going on in the country, we actually pledged initially that we're going to reduce our emission by 20%, unconditionally, and by 40% conditionally by 2030. And now we are raising it to 10 years. The question is, these conversations, like they said, blah, 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 is ongoing. What are the strategic steps that we want to take and the funding needed? Of course, they've committed to helping developing countries by raising $100 billion yearly, which they failed in years past, but they've committed, and you can see even South Africa, securing some to help. But we need to see strategic plans and see what we are doing so that it doesn't come to a point that we get stopped in the bit of transitioning from one energy source to the other.
That was actually what the AFDB president, the point he was trying to make yesterday. Anyway, let's leave this conversation here. Pelumi, thank you very much for your time.
Thank you for
having me. We do appreciate it.